Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Financial Reporting Standard 2, or you can say Indian Accounting Standard 102. The name of the standard is Share-Based Payment. Both these standards can be studied together because there are no curves or difference between them. Before we go ahead, there are two quick announcements to make. Firstly, all the videos of Ind AS are available in Hindi and English, both the languages. So whichever language suits you better, you can check out the playlist in that. Separate playlist is available on the channel. Secondly, the notes are provided to you in the PDF format. The link for the same is given in the description box. So don't forget to check it out. If you are new to the channel, don't forget to subscribe to the channel and hit the bell icon so that you don't miss out any new video. I think we're good to start. Let's begin. Let's firstly understand what is share-based payment. Whenever any entity purchases either any asset, service or goods from any other entity or its own employee and decides to pay the consideration in form of fixed number of equity shares, such payment transaction is known as share-based payment transaction. Okay, firstly it purchases any asset, service or goods and in consideration pays fixed number of equity shares. Measurement. The assets, goods and services that are brought from any other entity or from its own employee, then such are valued at fair value. The shares fair value is, we do not need to calculate the fair value of the shares. Instead, the fair value of the asset, good or service is taken as the fair value of the shares. For example, A Limited issue 10,000 equity shares, fair value rupees 10 for purchase of a plant of value 20 lakh. Okay, so the fair value of plant is 20 lakh. We do not need to calculate the fair value of the shares. Instead, the fair value of the plant 20 lakh will be taken as the value for the shares itself. Plant account debit 20 lakh to equity shares capital 20 lakh. Next comes account treatment of the share-based payment from any other entity. You need to first identify whether it is any asset, good or service, and then identify the amount or the consideration that has been agreed. Finally, you need to journalize it, asset, goods or service debit to equity shares and to securities premium. The balance amount will be taken to securities premium account. Okay, when we talk about service, okay, when the purchase thing is service, then the shares are issued only and only when the entire service has been received by the company or has been rendered. Okay, in such case, at each year end, the service expense will be debited to equity account, and when the final settlement year comes, at the time of that, equity shares will be issued, equity account debit to equity share capital, and the balance amount will be taken to securities premium. Next, share based payment when it is given to employee. It can be in four ways. Firstly, you can offer them equity scheme, that is, you offer them equity shares. Okay. Secondly, you offer them cash. That means in return of that service, in consideration for the service, you can offer them cash. Okay. Thirdly, you can give them an alternative, an option either to opt equity or to opt cash. Either to opt equity, option exercise, either to opt equity or either to opt shares. Final fourth thing comes is group settlement scheme. This is a way where an employee gives service to one entity and the group entity, any member of that group entity pays the consideration in form of equity shares. It can be in that way. For example, here there is a diagram, you will see this. Okay, here for example, employee provides services to holding company, but your payment is made by the subsidiary. In such case, this is known as group settlement. Okay. So see, it can be given in four ways, either equity, cash, or an option can be given to opt either equity or cash, and fourth comes group settlement. Next, equity settled scheme. It is equity scheme where shares are allotted either for past performance or for future performance. Whenever it is allotted for any past performance, then such is known as ESPP, that is Employee Stock Purchase Plan. Whenever it is allotted for any past performance of the employee, then it is known as ESPP, Employee Stock Purchase Plan. Whenever it is allotted for any future performance, okay, then it can be known as either ESOP or either equity. ESOP or equity. In equity, you do not charge anything from the employee, whereas in ESOP scheme, that is Employee Stock Option Scheme, you charge an amount that is known as exercise price from the employee. Okay, ESPP is explained better. Such shares are issued at discount always to the employee and then for the past performance, and then such amount is directly taken to the P&L because it is related to past performance. It is transferred to P&L under employee benefit expense. Such shares are locked for a particular period. That means a lock-in period is allotted, okay, has been laid out, that an employee, for example, he buys the shares, he exercises the shares at rupees 85 and the market price is going on 100. He can sell it the next day, okay, and get the benefit. No, to stop this, there has been a condition laid that an employee cannot resell it for a particular time period. That particular time period is known as lock-in period. The employee benefit expense that will be taken into the P&L, the amount will be the difference between the fair value of the locked in shares minus the exercise price, the price that has been charged from the employee. Now comes ESOP, that is for future. When there is future performance, either you issue ESOP, that is Employee Stock Option Plan, or you issue equity scheme, okay. Firstly, there comes two terms. There is a vesting period in which conditions are being met. For example, there can be any condition, performance condition, market price condition, turnover condition, service based condition, any condition. The period during which the conditions are being met, then such period is known as vesting period, whereas as soon as the conditions are completed, okay, are met, the right after that date is known as vesting date, whereas the date ahead such vesting period, you give a time period, a time duration, an open window like to the employee to exercise such shares, okay. Such period is known as exercise period. During this, conditions are being fulfilled. During this, an employee can exercise those shares. A contract date is there, which is done between an employee and employer. There comes a grant date at which the whole setup is being issued, is being started, is being initiated. The market price means the price that is being going on in the equity market of that equity share. Exercise price means the price that will be paid by the employee to exercise such option. In order to get those employee stock option plan, they have to pay some amount. That amount is known as exercise price. Intrinsic value, that means the final value will be market price minus the price charged from the employee, that is recovered from the employee, okay. There comes some important points that you need to understand beforehand. First comes grant date. Grant date, at grant date there is a fair value. It is taken after considering all the future fluctuations. Second comes vesting period. Vesting period is a period during which the conditions are being met, okay, during which an employee performs his services or any condition, market price, turnover, any such condition that has been laid down will be completed during such vesting period. Vesting date is the date right after which the condition gets completed, right? An employee's right arises to take such shares. Exercise period is during which employee can subscribe to those shares either by paying the exercise price or not paying as and when the condition is, the way the condition is. Recognition of expense. Entity shall recognize fair value of equity or ESOP as expense during vesting period over the SLM basis. Since these both are for future performance, okay, then such expense is not calculated and transferred to P&L in the 1 year. Instead, it is divided, it is transferred and charged to P&L over the vesting period on SLM basis, okay. For example, the vesting period is of 3 years and total the expense is 3 lakh, then it will not be charged into one P&L, 1 year's P&L. Instead, it will be divided by 3 and each year 1 lakh will be transferred to P&L on the SLM basis. This is simple calculation to understand. Equity and year, this is very important. Like people study whole of the standard and still don't get the difference between equity and ESOP. Equity and ESOP both are for future performance, but when you charge something from employee, then this is known as ESOP. Okay, your employee has to pay any exercise price, whereas if you don't charge anything from the employee entirely, not a single penny, then this is known as not charged any cash, then this scheme is known as equity scheme. Okay, the basic steps to recognize share-based payment. Firstly, see the number of employees. What are the number of employees? The number of shares that will be allotted. Fair value at the grant date. This is very important. You always take fair value of the grant date, the date at which the whole setup is being initiated, whole scheme is being initiated. Estimated departure. Okay, in case if you have like 3-year, 5-year long plan is there and you expect 10 employees will leave the organization or other 50 will not exercise the option, whatever your estimation is, if there is any estimation reduction in the employee, okay, then such number will be considered and adjusted. Next step comes is determine the vesting period, for example 3 years, 5 years, after which such shares will be given for exercise, okay, will be allowed to exercise, during which vesting period you have to recognize all the expense on SLM basis across the vesting period. Okay, this is very important here. This sheet can solve any of your question, any of your doubts. Okay, please see this carefully, take a screenshot of it, and other than this there is a PDF note available in the link form. You can download it from the description box. See, first comes number of employee. Okay, then the number of shares that will be allotted per employee, then fair value of the grant date. Okay, it is taken of the grant date. When you multiply these three, you get total expense. Okay, number of employees, number of shares that will be allotted per employee, and then the fair value at the grant date. Then comes vesting period. It can be variable, it can be fixed, but we are talking about the total vesting period, the period during which the conditions will be fulfilled. Okay, then comes cumulative expense, like the expense throughout the scheme will be what, but you will be charging to P&L what amount? The amount that is related to just this period, okay, on SLM basis. So you will minus any amount that has already been recognized in any previous year. For first year it is generally 0. For upcoming years it is the amount that has been recognized in previous P&L, previous year's P&L. Okay, so cumulative. And then for example in the first year and the vesting period is 3, so you will do this your cumulative expense. Okay, this will be for example F minus G, that is cumulative expense minus expense recognized till date. This will be charged to current year P&L, current year's P&L. Okay, next year you take the same amount, there comes total expense. Then here also vesting period will be same. After this there comes cumulative expense. You will deduct this. This comes from here, the previous P&L amount. The amount that was charged to previous P&L will be deducted from second year's expense till date recognized, if any, in the previous year. Okay, then after this, year 3, this amount will be taken over here. Okay, this is how it goes on. It can be for 2 years, 3 years, 5 years, 7 years, any. Okay, this format is legit format. This solves all your doubts, all your questions, and is exam oriented. Okay, you will get full on full if you use this format. Next comes journal entry. When it comes to equity, you do not charge any amount from the employee. No amount is charged from the employee. Whereas if we talk about ESOP, there is some amount charged from the employee, like exercise price. Here the entry will be employee benefit expense to share based payment equity, okay, reserve, whereas here it will be employee benefit expense to ESOP. Then finally at vesting period, share based payment equity reserve will be debited, which was credited over here, which was made, will be debited, and equity shares will be allotted. The balance, the difference amount will be taken to securities premium. Here, since you are charging something from the employee, then you'll get something into bank account. The ESOP account that was credited will be debited over here. You will issue equity shares and the remaining will be taken to securities premium account. Next, in case if the scheme is forfeited, cancelled in case, then the reserves that were made will be transferred to general reserve and it will be shown under other equity reserves and surplus. Now comes a topic, that is determination of vesting period. There are at times multiple variable conditions and the vesting period is not fixed. In this case, how will we deal with it? Let's see. If service condition is period condition, that means the employee is required to fulfill 3 years service, 5 years service. Or if it is service period, then such service period will be taken as vesting period. If it is 3 years service period, vesting period will be 3 years. Clear? But if service condition is not period condition but performance condition, it can be any performance condition, then in this case we see it can be any market price or any other condition, for example turnover condition, etc. Okay, so service period is taken as prescribed period is taken as vesting period, whereas in case of performance based it can be either market price or any other condition. Let's see what happens. If the market price is the condition laid out, okay, then at the time of calculating fair value at grant date, adjustment is made for uncertainty. When we take fair value of the grant date, you do all the adjustments, and then further if any uncertainty arises or changes arises, you do not need to change anything in the fair value that you have taken of the grant date. Okay. After this comes market price. It can be fixed vesting period or variable vesting period. In case of fixed vesting period, number of service period agreed is considered. It means vesting period is given in question. If it is fixed, then it is given in question. If it is variable, then prescribed period is specified with vesting and exercise. That means each year vesting period will change. It can be, and if it's variable, it is given in the question directly. Next, let us understand this whole thing with an example. Okay, A Limited offers 500 employees 50 equity shares and the target price is 70 rupees. That means it will be exercised when the target price reaches to 70 rupees and a period is given 7 years. Like maximum vesting period will be 7 years. If such condition is met, maybe first year, maybe at the second year, third year, we don't know. Okay, so as soon as the condition gets complete, for example, the condition got complete in 5 years. For example, you met a target price of 70 in 5 years. The remaining 2 years will be considered as exercise price. As soon as the condition gets completed, the vesting period gets over and exercise period starts, during which the right of employee arises to exercise such price. Okay. In such situation, entity shall estimate vesting period at grant date. Okay. Expenses are recognized in estimated vesting period. Okay. Estimated vesting period, for example, 7 years. The expenses will be divided into those 7 years on the SLM basis. You know this already. In case subsequently if vesting period is revised, for example, it gets higher or it gets lower. In case if increases, then ignore. You need to recognize only during the SLM basis on the vesting period which was decided on the grant date itself. But if in case it decreases and says like okay 2 years and the conditions are met, we will recognize whole of the expense today itself, immediately. Recognize all the remaining expense in the year in which such condition has been met. Okay, summarizing this whole. If it's fixed, then take the prescribed period as vesting period. If it's variable, period estimated at the grant date. You have to take vesting period as estimated on the grant date. Subsequently, if it increases, then ignore. And if it decreases, then recognize whole of the payment immediately, whole of the expense immediately. For example, even if 2 years were remaining and the condition got met today itself, then such vesting period got reduced. Since decreased, you have to recognize all of the expense in the current year itself immediately. I hope this is clear. Next comes is performance condition other than market price. There can be two conditions, either market price or any other condition. Other condition, for example, turnover basis. Estimated given or estimate not given. If estimate is given, then vesting period calculated at each vesting period. Okay. Whereas if estimate is not given, then 1 year ahead will be taken. That period expire plus 1 year. For example, 2 years expire plus 1 year, then 3 years will be taken. Always if estimate is not given, you always assume that okay, it has not happened today this year, then it will definitely be reached in next year, in upcoming year. Therefore, your vesting period is always taken +1. If estimate is given, then it is revised and calculated each year. It may be possible that some employee may not complete specified performance target. Okay, it may be happen that employee leave. Okay, they leave or they do not exercise the option. It may happen. So you have to estimate that departure also. In that case, you do not revalue the fair value and all. Instead, you recalculate and revalue and adjust the number of employees. Due to such variation, fair value at grant date is not adjusted, whereas the number of employees adjusted. This is very important. In case of number of employees changes due to any reason, due to any departure, simply, okay, so the fair value at the grant date is never adjusted. Instead, what happens is number of employees are adjusted. For example, they were 500, now it's 490 because 10 departed. So the number of employee will be reduced instead of changing anything from the fair value at the grant date. This is a important takeaway. Modification in the share-based plan, if any, then what happens? The terms and conditions agreed at the grant date, then there can be any increase or decrease in the exercise price, increase or decrease in vesting period, increase or decrease in employee equity shares granted, performance condition. There can be any sort of changes. Such modification may decrease the expenses of the entity. It means modification is in favor of employee. If it is in favor of employee, then it will be increasing the expenses of the company because it is favorable to employee, means there will be any payout to the employee. Okay, it increases the cost of the company and therefore recorded immediately. And if it's against employee, then expenses decreases. Ind AS 102 prescribes a specific thing that says grant date at fair value is the minimum expense. Very important. Please note this. Grant date of the fair value, okay, fair value of the grant date is the minimum amount that will be recognized. You cannot decrease it below that. Okay. If due to modification expenses decrease, then for accounting purpose such modification must be ignored. This is specifically provided in Ind AS 102. It is not provided in IFRS 2. Summary: if it's in favor of employee, then consider. If it's in against employee, that means the company is on benefit side, then you have to ignore. If you have a higher payout, then consider this and record this. Recognize grant date fair value as usual, and then recognize incremental expense due to modification in the remaining vesting period on SLM basis. See, the incremental amount will be divided across the vesting period on SLM basis. See, example, incremental how? Fair value of the modified share-based plan at the modification date minus the fair value of the original plan at modification date. Okay, what you see is, for example, in 2011 you initiated a contract. The fair value at the grant date was rupees 13. Okay, fair value at the grant date was rupees 13. You cannot decrease it below this because this is the minimum amount at which you will record. Then comes at 2003, for example, due to any modification, what happens? The new fair value is 14 rupees. In this case, you will see the fair value of the modification, on the modification date, the fair value of the modified share-based plan and then of the original plan. Okay, for example, if you recalculate at modification date, it was 12 and incremental was 2. Okay, then past expense as it is, that was 13. You calculate such amount, this is minimum amount, you calculate it as it is, and the incremental amount 2 rupees will be taken over the remaining years. This is how it will be calculated, 15. Okay, this is important. Fair value of modified share-based plan and fair value of original plan, both are taken of the modification date. The difference between such is known as the incremental amount. This will be divided over the remaining years on SLM basis. Graded vesting. Graded vesting means grouping of shares granted into different grade. Okay, each grade has separate vesting period. For this purpose, identify number of grades vesting period of each grade, number of shares in each and fair value of each, okay, separately calculated. Very important. For accounting purpose, each grade is subject to separate contract. It is considered as separate contract and accounting and expenses are calculated separately. Cancellation and settlement of equity shares. Cancellation of existing plan for new plan. In this case, accounted in similar way. Whereas cancellation of existing plan to close plan. If it is removed, the plan is cancelled, then recognize remaining expense immediately. Calculate total expense to employee. Total payment is divided into two. Up to fair value, it is deducted from equity and the amount above fair value is transferred to P&L. Okay. Cash settled share based payment. It can be like employee can be given an option to be settled in cash. The plan is a liability plan throughout. Since there is a obligation to pay cash, it is a liability plan. But because entity is obliged to pay cash, अगर कैश पे करना हो तो लाइबिलिटी है, एंड इफ इट्स रिक्वायर्ड टू पे इक्विटी शेयर्स देन इट इज इक्विटी. ओके. फॉर्म्स ऑफ एंगेजमेंट. फॉर पास्ट परफॉर्मेंस immediate vesting period, and for future performance conditional vesting period can be taken. Immediate vesting period plan means in this plan employee has not to perform any function. Since the vesting period completed, that means there are no conditions that need to be fulfilled in future. Okay, so the vesting period ends that right there and exercise period starts for exercise of cash. Okay, but entity allows some time period to exercise cash. Accordingly, fair value of liability changes at each reporting period. Following steps: firstly, recognize fair value of the grant date of the expense, that will be outflow. Secondly, change fair value at each reporting date shall be accounted as and when occur. If any changes occur in the fair value of the payment of cash, then it will be recognized and recorded at every reporting date. Last comes as conditional vesting. In this case, determine vesting period, recognize expenses during the vesting period or cumulative on SLM basis. Always recognize such multiple year expenses over the vesting period on SLM basis. Since this plan fair value of expenses revised each year and calculated as per latest estimate. At each vesting date, it will be employee benefit expense debit to share based liability account. Finally, at the payment date when you will be paying cash, then share based payment liability account debit to cash. In balance sheet, share based payment liability is presented as liability. Since it is a cash outflow, this means entity has an obligation and therefore it is recorded as liability. Otherwise, if shares are needed to be paid, given, then it is known as equity. I hope this is clear. The notes are given in the description box as a PDF link. You can download it and keep it for your reference. In case of any doubt, please comment down. I'll get back to you as soon as possible. See you in the next video. Till then, take care, be safe, stay tuned.